Want to retire with peace of mind and a steady monthly payout? The PIMCO Income Fund promises around 6% income a year, but is that really sustainable? Or is it just your own money coming back to you? If you're a Singaporean retiree or planning for retirement, you need to hear this before putting a single cent in. I'm going to break it all down. What this bond fund actually invests in, how it pays you, what risks are hidden under the hood, and how it compares to good old CPF Life. So hit that like button, smash subscribe to Wealth for You, and stay till the end. Because the difference between retiring well and running short could be in this video. Quick disclaimer before we dive in, I'm not a financial advisor. Nothing in this video is meant to be financial advice or a recommendation to buy or sell any investment. It's purely for educational and entertainment purposes, so please do your own research or speak to a licensed advisor before making any financial decisions. Part 1. What is a bond fund? First things first, what on earth is a bond fund? A bond fund is like a big basket of bonds. These could be government bonds, corporate bonds, mortgage-backed securities. Basically, it's money lent to others, and you earn interest from it. Think of it like this. You lend money to a bunch of people, and they pay you interest every month. A fund just does this on a much bigger professional level. Part 2. What is the PIMCO Income Fund? So now, what's this PIMCO Income Fund all about? It's managed by PIMCO, a big global investment firm, and this specific version we're talking about is the E-Class SGD hedged one. So it's in Singapore dollars and hedged to reduce currency risk. Its main aim? To give investors a regular monthly income. Sounds good, right? But there's more to understand. Part 3. Characteristics of the fund. Let's dive into what makes this fund tick. It invests in a mix of income-generating instruments like mortgage-backed securities, investment-grade corporate bonds, high-yield bonds, and some U.S. treasuries. Around 87% of the assets are U.S.-based. So yes, it's very U.S.-heavy. The fund uses derivatives and a bit of leverage to boost returns. That means it borrows to invest more, which can be good or bad depending on market conditions. It pays investors monthly. As of 2024 to 2025, it's been giving out about 6.5% annualized yield. But around 30 to 40% of that payout comes from capital, not income. The net asset value, or NAV, has been falling. Why? Mostly because of rising interest rates. When interest rates go up, bond prices go down. Simple as that. Part 4. What happens if interest rates fall? So what if interest rates go down? Well, that's where things could get exciting. If interest rates drop in the next year or two, the NAV of the fund could rise, because bond prices will go up. You see, bond prices and interest rates move in opposite directions. When interest rates fall, older bonds with higher interest payouts become more attractive, and their prices rise. That means the bonds held in the PIMCO fund could increase in value, which would lift the fund's NAV. So not only could you continue receiving monthly income, you might also see capital gains. It's like getting cake and eating it too. But again, no guarantees. Rates might stay high longer than expected, and that would keep the NAV depressed. Part 5. Is there Forex risk? What about Forex risk? The good news is this fund is SGD hedged. That means they've already done the work to reduce the risk of US dollar swings affecting your returns. But hedging isn't perfect. It helps, but doesn't eliminate all risk. Part 6. CPF Life versus PIMCO Fund. Now here's where it gets really interesting. Comparing PIMCO with CPF Life. CPF Life is a government-backed annuity. You put in a lump sum at age 65, or earlier with retirement sum topping up, and it pays you a fixed monthly income for as long as you live. It's guaranteed by the Singapore government and designed to provide you peace of mind that you won't outlive your money. PIMCO, on the other hand, is a privately managed bond fund. It also provides monthly income, but that's where the similarities end. Here's the reality. Your monthly payout from PIMCO is not guaranteed. Your capital is not protected. It can fluctuate, and it may decline over time. Your monthly income can vary, especially in poor market conditions. And up to 1/3 of your payout may be your own capital being returned to you, not income generated by the fund. So yes, it looks like CPF Life on the surface, monthly payout, retirement income, etc. But it's really more like an income-generating investment product with no safety net. CPF Life gives you lifetime income no matter how long you live. PIMCO gives you income only while the fund lasts. If NAV drops too much, your capital and future income may shrink. So while both can serve the purpose of retirement income, CPF Life is like a safe, steady bus route. PIMCO is more like driving your own car, potentially faster but also riskier, and you have to watch the road. Part 7. Should you max out CPF Life first? It's wise to maximize your CPF Life first. It's safe, dependable, and provides income for life, guaranteed by the Singapore government. Once you've secured that foundation, and if you still have extra cash that you'd like to put to work for more income, then yes. A fund like PIMCO might be worth exploring. Just be sure you understand the risks and structure before diving in. Part 8. Cost and where to buy. You can buy the PIMCO Income Fund through several fund platforms in Singapore. The most cost-effective place at the moment is Endowus, which rebates part of the fund's trailer fees. While the fund's gross expense ratio is around 1.45%, with Endowus you effectively pay around 0.55% annually. Do check the platform's fee structure before investing. Part 9. Pros and cons. So let's round things up with a balanced look at the pros and cons. On the plus side, this fund gives you monthly payouts of around 6.5%, which is attractive for retirees who need regular income. It's also SGD hedged, which helps reduce currency risk for Singapore-based investors. The fund is managed by PIMCO, a reputable global investment manager, and offers strong diversification across a wide range of fixed income assets. So you're not putting all your eggs in one bond basket. But there are trade-offs. A big one is that part of the payout comes from your own capital, not just investment income. That means over time, your original investment could shrink. And speaking of shrinking, the net asset value has been declining, largely due to rising interest rates. Also, the fund uses leverage to enhance returns, which introduces more risk. And importantly, there's no capital guarantee, unlike CPF Life. So while the income may feel steady, you need to understand what's going on under the hood. Final thoughts. So, should Singaporean retirees invest in the PIMCO Income Fund? If you've already maxed out CPF Life, have spare cash, and want monthly income with some flexibility, this fund can be part of your diversified plan. But don't expect it to grow your money. This is more like an income now tool, not a get-rich one. Thanks for watching. If this helped clarify things for you, give it a thumbs up and don't forget to subscribe to Wealth for You. And let us know in the comments, would you invest in a bond fund like PIMCO? Till next time, take care and invest wisely.